Welcome to another STANLIB webinar. It's great to have you join us today. As you can see, we're sitting in the office. We've got a great camera crew with us here, and hopefully they're giving some more flattering angles of us than you usually get from our laptop webcams. Today we had to talk about asset allocation for income and growth. And the way we're going to talk about that today is by considering the views of our fixed income team on the broader market and how they're taking those views and then implementing within the STANLIB Flexible Income Fund. Before I introduce my colleagues today, just a couple of formalities. In terms of CPD points, if you would like to be eligible for those, just make sure you stay tuned in for the duration of the session. And also please make use of the Q&A box. We would like to allocate some time at the end to taking those questions. Any that you don't get to, we'll also happily get back to you after the session, but please use that functionality so we can make the session as relevant as possible. So I'm sitting here today with two familiar STANLIB faces. I've got Sylvester Kobo, who is the deputy head of the fixed income franchise at STANLIB, as well as Victor Mphaphuli, who is the head of the fixed income franchise. It's great to be here with both of you today.
Thanks, Dave.
Briefly, before I hand over, just in terms of how we're going to run the session, I'm going to give the first 20 or so minutes to Vic, who's going to just position the sort of backdrop and set the scene in terms of what is happening out there in the world. We all know there's a lot of noise, there's a lot of data flow at the moment that makes the world a bit of a scary place, but undoubtedly that creates opportunity as well. After Vic has set the scene, I'll then sort of facilitate a discussion between Vic and Sly, just in terms of how we take that, how does the team process and distill that information, and then implement within the portfolio as mentioned. And then finally, we have allocated time at the end, as I mentioned, for Q&A from the audience. So please do make use of that, and we'll get to as many of those as possible. So with that, Vic, I'll hand over to you, and we look forward to hearing what you have to say.
Yeah, thank you very much, Dave, for the kind introduction. I mean, before we came to the presentation, I was thinking, sure, do we have, the right, headline, for this presentation? Because we could have basically called it decision making under uncertainty. And the reason why, I said that is because portfolio managers these days, have to deal with a lot of volatility, that has crept into markets, and it doesn't really matter which asset class you're looking at. Other than cash, most asset classes that we're dealing with are in serious negative territory. Who would have thought that an asset class that is normally used as a diversifier, in clients' portfolios to reduce volatility in periods like this, would in itself also be experiencing a bear market, of its own. And the reason why, this is happening, as I will show, later on in some of the slides, that I have, is because of the slide that you are seeing, in front of you, and these are just, some of the few issues that investors have to deal with in positioning and managing their portfolios. And if you go back, to pre-COVID world, everything was working quite well, asset classes responding quite well also, to different variables that would drive them. But post that, there are a lot of factors that market players are not used to. And certainly, in most of the conversations that we have had, either with clients or maybe with other experts, in the field, the main message that comes through is nobody really knows where we are actually going to end up. And as a result, investors are finding it very difficult to put pronounced positions, on their portfolios. You've got issues that we have to grapple with around inflation, which keeps on rising, by the way, but also at the same time, we are worried about what all these central bank actions are going to do to growth down the line, which in itself, if it comes to play and we end up having a recession, it's also going to have implications, for example, for emerging markets and a market like South Africa in particular. So there's a lot that we have to play with. It's not a nice environment for central bankers when inflation is rising the way that it's doing, but also growth might look like it's going to cool off down the line. So as a result, over the past few weeks, we saw markets recovering, quite nicely. I think for about 4 to 5 weeks. I mean, risky assets doing well, equity markets also outperforming, even the debt markets also doing well. U.S. Treasuries, I mean, coming down from 3.5% to a low of 2.55%. But then all of a sudden, the call that was being made was basically on whether central banks are going to pivot and basically be less hawkish. I mean, because of the concerns of what their policy actions is going to go do, to growth. So it all got to a hit when we went to Jackson Hole, where everybody was expecting the Fed, for example, to pivot. But the message, I mean, that the Fed sent is that inflation is a much bigger beast to fight than growth, which maybe they might have to deal with later. So as a result, you even seeing central banks like the ECB, which previously, I mean, has been known for keeping interest rates, I mean, at benign levels, and now they are talking about aggressive hikes. I mean, I was reading a researcher from another analyst that was basically saying the ECB could actually even go for a 1% hike, but they're going to choose, I mean, 75 basis points. So that's not small. And I mean, and as a result, I mean, September sees the most hikes that we are going to experience in a very long time. So it doesn't stop there. I mean, the war situation in Europe, it's still going to impact markets. It's still going to impact inflation, but also impact growth. You would have seen the stories around Russia, I mean, switching off energy, to Europe. Europe having to look for alternatives. And now we're talking about the UK inflation going up into double digit, probably even higher than where it is. The European inflation, I mean, for the first time in a long time, also looking to go into double digit inflation. And as a result, everybody has to respond to this. But all these actions that we are having is going to have an impact on growth down the line. I mean, for the moment, the labor markets are still quite tight, particularly in the US, which basically, I mean, gives the Fed an opportunity to continue to be aggressive. And as a result, I mean, markets have actually pivoted, instead of the Fed pivoting like it was expected. And China also, I mean, is presenting its own risks, I mean, to the global markets, the way that they've responded to the resurgence of COVID in their markets. You looked at the export numbers, and for example, I mean, yesterday, they were quite low, and those are going to have an impact on emerging markets in general. So I suppose maybe it really boils down to whether this the picture that I'm showing here is going to continue, which is what I was talking about, the bear market that even bond markets, I mean, were experiencing. And it didn't matter where you are, whether you are in North America, South America, Europe, the Asia Pacific, all in all global bond markets have struggled, and it has made it very difficult for asset allocators and to allocate, I mean, capital on behalf of clients. And even if you were to run a balanced strategy, a traditional balanced strategy of 60-40, you were still going to have significant negative returns on your portfolio. So as a result, I mean, cash at the moment has actually become king. And yeah, so managers, I mean, would need to find a manager that's able to do this asset allocation in general. So what I've talked about earlier on has had an impact on our local currency, of which, I mean, there were times that it performed well, for example, in February, when we were having the windfalls, but eventually, I mean, it did catch up with other emerging markets, and it continued to weaken. And this presents risks of inflation, because it can start to feed through into imported inflation. And the one thing that our local central banks, I mean, has vowed to do is that inflation is a bigger beast to fight, because it's a tax basically to the poor. So as a result, we might still continue to see rate hikes, I mean, from our central bank. Our bond market was not spared. So the way to look at this graph is every time we are in the shaded area in comparison to economies that are in the same rating as us. Remember, we are in the BB rating space by rating agencies. We have actually, on average, for the past 12 months, on our dollar-denominated debt, underperformed most emerging markets. So the story, I mean, obviously being that there is a lot of value, that sits in the South African bond market, but the current volatility is still going to make it very difficult, I mean, for people to rush back, I mean, onto the asset class. So basically, there's going to be a better time period, I mean, for investors to basically, I mean, get back into the markets and put risk on our portfolios. So earlier on, I talked about inflation being a bigger beast, central banks having to respond to that. But that response function from central banks is going to have to be felt somewhere, and it's going to be felt in growth numbers. You would have seen also, I mean, the numbers that came out in South Africa, although slightly better than expected. It's still a negative number, and that's also, I mean, largely caused by domestic issues like load shedding. So you can imagine an environment where the US and maybe other economies in, for example, Europe, enter into a recession. So that in itself, I mean, it's going to have an additional impact on our markets. So this is the forecast, I mean, for how GDP is going to perform, in 2023 for different economies. The picture, as you can see, other than Russia and China, most of these economies are actually going to see growth cooling off, which obviously, I mean, as I said earlier on, makes it complicated because it's cooling off at a time when inflation is still showing signs of increasing. So, and just bringing it back to the domestic market, our central bank doesn't have a choice, because if anything, you look at the graph on the right, which shows inflation expectations 1 year ahead and inflation expectations 2 years ahead. Those have actually started to rise, and they are now sitting well above the 4.5% percentage level that the SARB prefers to track. So they can't allow this inflation of expectations to continue to de-anchor, because by doing so, it would mean economic agents, including labor, for example, is going to continue to demand above, I mean, inflation or the average inflation number that the SARB, I mean, is comfortable with, so that, I mean, their living conditions can catch up with current inflation. So, in the best way, I mean, to deal with this would be to continue to hike rates. And in our view, I mean, we think for this year alone, there's probably another 1% hike that we're going to see, and then into next year, another 50 basis points of hikes that we're going to see. Just so that you look at the graph, I mean, on the left, just so that the real interest rates, I mean, for the country can start to normalize, I mean, back to what is considered a neutral rate. A neutral rate is basically where if you go slightly, I mean, above that, then you can start, I mean, to slow down the economy. If you go below, if you stay below that, then you're probably going to, I mean, continue to have this inflation problems. But like every other central bank, I mean, globally, it is a race to neutral, and also, I mean, getting slightly higher, just so that we can give ourselves, I mean, a chance to have a dent, I mean, on those inflation expectations. And certainly, I mean, if you look further out on the graph on the right, you can see that because of the activities or actions that the Reserve Bank is expected to take, those inflation expectations, I mean, they start to taper down. I know today when we look at the number, we say it's 7.8%, but into, I mean, for 2022, that number is probably going to average just above 6%, and further out, I mean, inflation is probably going to be maybe between 5 and 5.5%, which is a slightly better place to be. But the risk, of course, I mean, even then, is that whether we can get back to levels that we saw previously, like below the 4.5%, or whether inflation is going to be sticky. So if it's going to be sticky above the preferred levels, then it probably means that even our domestic rates will probably maybe stay after they've increased rates. We'll probably have to stay at higher levels than we were previously used to. But what works well for South Africa, because I mean, this is a question that we get asked a lot, is why is our inflation not like Turkey's inflation? I mean, is it 80%? You know, why is our inflation not like Sri Lanka, for example? Why are all these other emerging markets, I mean, having inflation that is higher than South Africa? Part of the reason is that as a basket, food inflation and energy inflation, in terms of contribution to the inflation number, you know, for the basket for South Africa, is actually lower than what on average emerging markets are experiencing. You know, so South Africa, it's at like 15%, and the average for emerging markets that we compete with, it's sitting at 30%. And then you look at energy, it's at 8%. South Africa is at 5%. So that basically, I mean, explains why, even though inflation is rising, it's not getting out of hand like we have seen with other countries. Of course, I mean, on the right hand side of the graph, I've got the euro area and the US, which, by the way, I mean, it's still gonna continue to experience some problems, given that their winter period is coming through, and then there's gonna be some struggle, I mean, around the supply of those energy prices. You know, earlier on, I've talked about inflation expectations and what, for example, labor, you know, I'm talking about your unions, are going to demand. So this is the picture. I mean, as we stand now, the blue side, I mean, which is on top, is basically showing the different settlements that have already been experienced in the different sectors. What is clear is that all of them are settling above 6%, with some of them obviously negotiating wages that are going to be higher than the top side of the inflation target for quite a number of years. You know, so this is concerning for the South African Reserve Bank, and they have to fight, I mean, to break the backbone of inflation, so that in future those negotiations, I mean, would center around the 4.5 level that they prefer. So, and the problem, I mean, it's still continuing. I mean, the bottom side of this slide is what is still pending and still being negotiated. Again, I mean, what is clear is you look at SARS, public sector, you look at Samanco, for example, you know, those numbers are and they are very high, you know, in comparison to that top side 6% that I've talked about. Yesterday, I think, I mean, there was another union, I mean, that was basically demanding numbers that are also, I mean, above inflation. So the SAB doesn't have a choice. They have to keep on fighting to break this. And anyway, hiking rates would also help, I mean, in trying to contain the impact on the currency, because you can't have a situation where global central banks are now starting to hike rates aggressively, and we are not doing enough. The reality is that the differential between ourselves and those developed markets and economies, it starts to tighten down. And if it tightens down by a lot, the pain of that, the release valve, I mean, for that is basically the currency, you know, which, I mean, by the way, already, I mean, you're seeing it weakening, you know, every time that global central or developed market, I mean, central banks give an indication that they're going to be increasing rates. And also, I mean, what doesn't help is that, especially for market players, I mean, like ourselves, what doesn't help is that most of these increases, you know, that you're seeing now, you know, we all do know that at some point inflation is going to come down. We are supposed to be looking through the cycle, but nobody is willing to do that, you know. And the reason why they're not willing to do that is because central bankers keep on telling us that their response function is going to be data dependent, you know. So as a result, on Friday, you get employment numbers, I mean, from the US, it looks like unemployment maybe is rising from 3.5 to 3.7, and riskier says they are happy. Our yields also come down. And then you come, this week you see the ISM numbers, for example, coming globally, and then everybody says, oh no, the economy is actually still doing well. The Fed doesn't have to pivot. They can actually continue doing what they are doing, and then the result is that yields again, bobbed up. You look at U.S. Treasuries, today trading above 3.3%. And if this inflation problem continues, there's a higher probability that in the short term, we could still rise and get better levels to get back to the market. But I know that the picture that I've presented, it sounds very dire, very concerning, which is why, in your portfolio, you need to have diversifiers. For now, for example, you also need to have cash, because it's starting to also look maybe a bit compelling, but also you need to have those portfolios that can allocate quite actively and be defensive, just so that you don't have the bigger drawdowns, that I showed you earlier on, where there was no place to hide. So the picture, yes, down the line, I think my view is that, or our view is that it's gonna get better. Valuations are looking okay. Except, for that we still just need to deal with the short-term noise, that we are experiencing. In South Africa, we're going to be having the medium-term budget statement later this year. The fiscal numbers are looking good. Who would have thought? Back during COVID, we were talking of debt to GDP for the country going above 100%. Others even talking of potential imminent default. Back then. But I think, the picture has improved, quite significantly, as you can see by the graph, that I'm showing. So in the short term, lots of volatility. In the long term, it's going to present opportunities, and which is why, it creates relevance for the type of portfolios, that we are also going to talk about today. Okay.
Thanks for that, Vic. I think that certainly paints the picture. And I think one or two points that stuck out to me is, one, it's been a very difficult environment in terms of there hasn't really been anywhere to hide for any investors out there. And secondly, that dynamic you spoke about, that there's almost two calls you have to get right. You've got to first understand what is going to happen, and then you've got to decide how you position for that, because sometimes the market doesn't respond the way that you think it's going to. So it's quite a difficult environment, but I'm glad you ended on a positive note. There are definitely green shoots. So I want to bring it back towards the portfolio, so the Flexible Income Fund. I think I'll just start with a statement, and that's sort of, if you look at how the fund is positioned, and we'll get into it, it's quite defensively positioned at the moment. And I think, in my opinion, what happens, clients who enter the portfolio now are actually buying optionality, because the fund is sitting in a position where it has cash to allocate. And we all know that it's an emotive thing when we're dealing with our money. And once you're sitting in cash, to get back in the market is an incredibly difficult thing to do. So when you hand that decision across to the fund managers and the teams that are looking at this on a daily basis, you allow them to make those asset allocation decisions, for them to decide when do we actually dial up risk again. So that's just a statement I would make up front. And maybe just to go back to basics, and Sly, I'll just position a question with you, please. If we look at this fund, the benchmark is obviously one of the important things people look at when they're considering a fund. This fund has a benchmark of 110% of STEFI. And it would just be interesting if you could explain to the audience why we feel it's appropriate that this particular mandate has a cash-linked benchmark.
Okay, thanks, Dave, and good afternoon to our viewers. So as you know, in South Africa, we don't have appropriate credit benchmarks or indices like, the rest of the world, or, the Western world. So really the choice for us was the 110% of STEFI, which is in line with our peers, or use the OLB 1 to 3 year area as a benchmark, which was widely used previously. But, that part of the curve has gotten so thin that, the bonds that are in that part of the curve are not representative of what's out there. But more importantly, why we chose the 110% of STEFI is that it forces certain portfolio manager behavior, in a sense that because you're not benchmarked to something that can lose money, i.e. if we're say, for instance, benchmark to Albi can return minus 10%. I mean, Victor showed minus 16% of bonds across the world this year. But because this is a cash benchmark, it changes how you view risk. So for us, the way we view risk in this portfolio is absolute loss of cash, right? It's not relatively, yes, the benchmark can lose 8%, minus 8%. If you do minus 6%, you celebrate and said, I did good for the client. So meaning we can't lose cash. And that is the backdrop that, talks to the positioning that we have now. When everything else is losing cash across the world, the way we think about asset allocation and making sure we deliver to the promise we gave our clients is we should limit drawdowns as much as possible in this portfolio while giving our clients that upside participation over time.
Okay, brilliant. Yeah, so I think key there that, a key focus on risk and how you think about risk, because I think risk can be defined multiple ways, but in this case, maintaining clients and growing clients' capital, keeping it safe, that's key here.
Yeah.
I suppose if we go a layer deeper than that, and you start looking at, what are the bounds within this portfolio, where can it invest? We'll just look at the SAA for this fund, the strategic asset allocation. And we've mentioned this before to clients that a number of years ago, there were some enhancements made to this.
Yeah.
Maybe we could just spend some time unpacking again what the reasoning behind that, the thinking as to why those enhancements were made.
So previously, when we merged this, the STANLIB Flexible Income with the then Aggressive Income Fund, we decided to keep it as a pure Reg 28 portfolio, meaning it could take off benchmark RAs into property, and that was in the region of 20-25%. And when property went through its woes in 2018, we had big drawdowns on the portfolio. And we had to obviously look ourselves in the mirror and say, given the client's profile in this portfolio, are we really doing it justice? So we consulted with our smart analytics guys, our PhD guys, and drew up this SAA, came up with this SAA that you're seeing on screen here, basically talking to how can we make sure that, this is not just a pure or conservative income fund. There's an element of risk or capital risk that we take in this portfolio that can give our clients a nice upside, but also limiting the drawdowns in the portfolio as much as possible. So diversification was key, which is why we introduced other asset classes like prefs and offshore, also to lower the correlations of, especially in stress scenarios or in stress markets like we experiencing now. And also, I guess, more importantly, we limited the amount of property we can have in the portfolio. So SAA guideline of 7.5%, we can stretch that to 10. Importantly, it also gives us as portfolio manager leeway that if we don't like an asset class, we can take it down to 0, because there's not a big component that if say property is 25% and we're at 0 and it runs, there's you'll take time to recover there. So that was the thinking about this. And good thing is we've implemented this in 2019 or, tail end of 2019. So the portfolio has seen the worst of stress, right? It went through COVID, it delivered. And also since COVID, the 2 years since, we're still in, very uncertain environments, and it continues to deliver. Drawdowns are limited. It gives our clients a positive return. So we're happy with that. We at least gotten to a point where the SAA does what the portfolio is supposed to do for us.
Okay, brilliant. Thanks, La. So, if we look at that SAA, you can see the fund obviously has quite an appetite for bonds. It can take on quite large bond exposure, understandably. But maybe just chatting about that, and you can see on the next slide, in terms of that bond position has actually been brought down quite substantially in recent times, which may seem counterintuitive to some of the audience, given the fact that there's a lot of narrative out there in terms of, very attractive real yields on a risk-adjusted basis out of South Africa.
Yeah.
Maybe you could just spend some time again unpacking the thinking behind reducing that exposure in a time where guys might be thinking, well, shouldn't we be going the other way?
So we actually had our TAA meeting this morning where I was presenting the nominal bonds view or return expectations over the next year. And I said, based on our forecast and modeling, bonds should give you 18.4% total return over the next year. Caveated that with but I still think we shouldn't buy bonds here. They'll get cheaper, and you can imagine the uproar in the room. It looked like a Vic who's chairing the committee. It looked like he's in a shebeen trying to calm everyone down. But the thinking is for us, I mean, and this is true to our philosophy or the way we view the world, right? We had very weak or everything sold off into June and July, and beginning of August, like Victor said, the central bank action now forces us to be so data dependent. We had one inflation print out of the US that came below expectations, and we saw all risk asset rally, bonds included, at the beginning of the month. And our takeaway was, one swallow doesn't make a summer. We still need to see more. Inflation is still very high, 8.5% in the US, is far away from their target. So true to our philosophy, we said maybe this is time to actually take some money off the table, right? Even though we constructive bonds over long term, but given that from the top to the bottom, bonds ran by 100 basis points, we should, take the money and reassess, right? And we reduced that fixed bonds portion from 45% to 16% that you see now. We rotated into credits because those are floating rate notes that give you a nice, as interest rates are rising, you reset with interest rates, so supports the yield of the portfolio nicely, but a large chunk of it went into cash. And that talks to that benchmark of it frames how you view risk. But we're not saying, even though cash now, I mean, if you look at 1 year NCD close to 8%, that is a decent return, right? Given that everything else is in the negative. But we're not saying in cash to stay. We are looking for opportunities. We still feel there's still another probably 40, 50 basis points higher in yields, in which case we'll deploy the cash. So dry powder, even though we're positive on bonds. So expectation is bonds over the next year will give you 18%, but we know they will get weaker, and which is why we keep in the high cash allocation currently.
Okay, brilliant. And I suppose also there, I mean, in the bond space, we have seen significant volatility, like you mentioned, since COVID.
Yeah.
Extreme volatility, and you've got to consider that factor as well in terms of, what volatility are you exposing this type of client to, and is it the appropriate mandate for that? So I mean, if we stay on the topic of the bonds in the portfolio, and we can tackle some of the other asset classes shortly, but looking at the bonds specifically and the duration in the portfolio, how you've managed that over time, maybe just chat about that, how duration has moved over time, and then also how you actually get that exposure. So I know you guys have had a preference for using sort of R186s or bonds that have a shorter date than, say, 10 years. Why would you do that instead of potentially buying a 30-year bond? What is the reasoning behind that, perhaps?
So the duration positioning now talks to that worrying inflation picture that Vic spoke to earlier, and central banks having to do more to contain inflation, and short rates remaining higher for quite some time, and the uncertainty that's in the market currently. Like, we've really had to contend with the fact that we have to get comfortable with uncertainty for quite some time still, because the world is such a mess, especially if you throw in the geopolitics into play. So then we had to, not from an asset allocation point of view, we had to look at the portfolio sensitivities that make sense for this environment, which is why we've reduced duration so our neutral duration positioning for this fund is around 2 years. That's if we're neutral, but we can hike it up as high as 5%. But if we are worried about the world like we are now, we can actually take it as low as 0 to look like a conservative income fund, which is where we are now. 0.6 years is quite defensive. Yes, it drags the yield of the portfolio for now, but we still feel for our clients, there is better opportunities to dial up risk. And as you can see with the portfolio duration on the screen, we're not shy to really express our higher conviction bets in the portfolio. When the yields sold off to, say, 10-12% in the short end back in 2020, we took the duration of the portfolio to over 4 years. But now there's just so much froth in the system that we think low duration strategy makes sense. Okay. And to your question around using the R186 bond instead of the R2044, I mean, if you look at, so 186s today, 9% versus, say, close to 11.5 for 2044s. Remember, this is still an income fund, right? So there's a certain behavior that our clients in this fund expect. And so we don't put in bonds, even though the yield is juicy, like you say, from a real yield on many metrics, but because of the high sensitivity to interest rates and the capital component of those long bonds, we feel they're not suitable for this portfolio. So we use that R186 bond, pushing it the 7-year bond, which we feel we can build up the duration that we want without taking undue capital exposure in the portfolio.
Okay, brilliant. Yeah, thanks, La. So I think I'll give you a break and I'll pass a question over to Vic, let you have a sip of water.
Thank you.
So obviously, the beauty of this fund is it's got that flexible mandate. You guys are evidently using it. It's got the ability to use multiple asset classes to get different sources of alpha, different risk mitigators. Vic, maybe you can spend some time talking about, the offshore component of this fund. And in that discussion, maybe just chat a little bit about your RAND views as a team. I mean, at the moment, based on some of the comments you've made, it sounds almost like it's very much a strong dollar story at the moment, as opposed to a weak RAND. I mean, some of the fundamentals you mentioned speak to actually nice tailwinds for the RAND potentially down the line.
Yeah, so the bottom line is that there's still a lot of volatility, globally. And that volatility is hitting emerging markets, and it's going to continue to do so. Like I said, earlier on, for as long as central banks, continue on their hiking cycle, and as that happens, like I said, also, earlier on, the release valve, particularly for markets with flexible currencies, like South Africa, is going to be felt on the currency, So we are now obviously, we've weakened. We've gone above 17 to the dollar, which has played quite well into the way that we manage this fund, where we if you look at the bottom right graph, for example, where you can see that there's been a lot of activity in terms of positioning into that asset class. But where we've also been finding it a bit challenging is that when we go offshore, you can either go and buy for example, a bond portfolio, say with our global partners, or you could, for example, also go and buy, say, global properties, because we've got access to that, or any other asset class, for example, that you could use, into that space. And so where we've been finding it hard is that some of those asset classes on their own have actually been struggling. In the last tactical asset allocation, before the one that Sly, talked about earlier on, the view, that came from the discussions that we had was that there's still a lot of froth in the market. There's still a lot of volatility that's going to continue, including, when US treasuries, for example, came down to 2.56, including the call that actually markets are probably getting ahead of themselves, and it might come to a hit, at Jackson Hole. So on our side, we felt it was an opportune time to reduce, let's say, our foreign exposure in property, because those numbers were actually, looking dire back then. But when we reduced it, we didn't just reduce it and bring the money back. We put it in dollar cash portfolios, and so we continue to do that, and that talks back. So basically, the main message is across all the asset classes that we're managing, because of correlations, rising the way that they are, it does call for that defensive positioning, just so that the drawdowns, on clients' portfolios are low. And as you can see, like I said, on the graph that we're showing, for quite some time now, we've always had an allocation in the offshore market. And when it becomes cheaper and looks compelling, even from an asset class point of view, let's say, for example, your US treasuries, which are at 330, say they get up to 3.5%, maybe between 3.5% and 4%, then that's going to create a great opportunity, for us to use that dry powder, to get into an asset class that can give us actual returns, also on their own. So for now, defensive across the board, until we go through this very difficult period that is being driven by central bank behavior. And maybe lastly, Dave, this allocation, it talks back to what Sly was talking about when we introduced other asset classes, because the main aim was to find a way of reducing correlations on the portfolio. And I mean, what a great way, I mean, to do that, having access to that foreign component. And as you can see, I mean, we use it quite actively.
Yeah, thanks, Vic. And I mean, again, speaks to that point of you building optionality in the portfolio. And in the times of volatility, you build optionality for future opportunities.
So yeah, for now, you know, the currency volatility, unfortunately, is not on a fair value basis. You know, I mean, the currency should probably be trading better than where we are, you know, currently. But it can't, for as long as you're not getting any indication from central banks that we are actually about to get down. And even if maybe they get down, it also depends on how far have they gone in hiking rates. You know? Have they become, because they're trying to get credibility back. In doing that, have they created a situation where now you end up with a recession? And if you have a recession in the short to medium term on its own, it can create, again, you know, its own volatility for emerging markets, because your current account, you know, that we've been talking about, which has been positive, I mean, for some time, it can start to reverse. And as you know, I mean, classical, I mean, economics, you know, or textbook economics, when your current account, I mean, suffers, again, you know, the pain can still be felt, I mean, on the currency side. So it makes sense to wait, you know, for some confirmation. But the beauty is that we're able to do that for our clients. You know, they don't have to do it themselves. You know, and it limits the probability of missing an entire market when markets do start to turn.
I suppose that's the point. I mean, that I made right up front as well about, you know, going to cash is one thing, deciding when to redeploy is a much more difficult decision to make as an individual. Maybe Sly, just if you want to comment on one or two of the other asset classes we haven't spoken about. I mean, obviously we've touched on the fact that, you know, the money market exposure has picked up, so cash in the portfolio is higher. I think we've addressed that. I don't know if you want to make any additional comments. And then I suppose on the property side, maybe a comment there, but also great to see what you mentioned in terms of, if you don't like something, you're happy to own zero. You can see periods of time there where you actually have had no exposure because you don't like the asset class.
Yeah, I mean, Dave, let me say up front that on the basis of valuations, all these asset classes are attractive, way more attractive than cash. Property is attractive, given where, you know, where we are now. So are bonds, but overall positioning for this portfolio now is we still expect some headwinds, you know, as more clarity around central banks' actions come through and how, you know, economies contend with that or deal with that. And once that has cleared, you know, we feel there is an opportunity for us to stay out of the market and actually wait, you know, for those points where things get cheaper, and then we can resume our allocation. It's not that because we're close to zero on property, we don't like the asset class. There's just so many things that are going for the asset class now. We've been through a recent, you know, result presentation of some of the key companies, and it's not looking bad, right? Yes, GDP is suffering a bit now, but, you know, they came from a very low base. But we're saying there's a lot of headwinds, a lot of uncertainty for now. We will, like Vic said, you know, talked about the dynamism of the manager choosing when to get out and when to, you know, engage the markets. We think there'll be better entry levels, which is that's basically the view on property, or, you know, cash for that matter. Yeah.
And I suppose maybe you can correct me if I'm wrong, but I guess that speaks to the fact that, you know, you don't always have to time the market perfectly. So yes, you'll wait for more clarity in terms of when is it a better time to be in more bonds. And yes, you might miss the first part of that rally, but, you know, you're not trying to time the market perfectly. And it also 100%. Saves you on the downside as well, which is equally important.
As Vic always likes to say, you've got to be willing to leave some rents, you know, in the street, because you can never time it perfectly. But because we are very close to the market and we're dynamic in our approach entirely, we feel, you know, we're best placed to be able to call that turning point and redeploy the cash accordingly.
Yeah, and yeah, you talked about timing. You know, it doesn't mean if we say bond yields are gonna get to 4, it doesn't mean you're gonna only buy at 4.
Yes.
You've got to fade it in. Otherwise, I mean, you run the risk that in a data dependent world, that central banks are talking about, Powell can stand on the podium and say, we worried about the economy. I mean, we think the economy is cooling off much more than maybe we initially expected. That's going to create a huge rally, for the markets, So, and if you're just waiting for one number to tick off, you're going to miss the entire market. But as I said, because our approach, I mean, our philosophy, also includes staying very close to the markets. We are more likely, I mean, to pick up that value, as it comes through. Of course, in the short term, it might look it's looking cheap, but the way that it's playing, out, one could also say that maybe it's looking cheap for a reason, you know what I mean, in the short term. But there's going to be a time where you don't want to miss the market. You need to go back in, not just for fixed income, but maybe even for other asset classes. But if you're going to have a recession, I mean, medium to long term, fixed income does tend to benefit, I mean, a lot more also.
Absolutely, yeah. Well, thank you for the input. I mean, I think importantly, we can talk all day about this. In theory, what clients want to know is it doing what it says on the tin? So, I mean, we can just chat briefly maybe around the performance of the fund, how this fund is delivered for clients. So maybe just a couple of comments from your side. It should be up on the screen there for everyone in the audience to see.
Yeah, I mean, Vic put up a graph that showed how bonds across the world lost so much. And, over 1 year, 3 year, and 5 year, you can see the portfolio still continues to deliver to its promise. Obviously, headline performance numbers a bit lower than they were last year, given how rough the first 6 months of the year has been. But it continues to deliver, and we think, we have a fortunate position where we are now. That we can add a lot of upside going forward for our clients, given that we sit in largely in cash. Bonds have retraced or sold off about 60 basis points since we took that position. And as we start fading it in now, we'll start crystallizing some or adding some capital onto the portfolio, and it should give you, a lot higher, outperformance versus cash than like it did last year, for instance. But to answer your question, Dave, it is still continuing it's doing what it's meant to do.
Yeah,
brilliant. Look, I don't know if you want to add anything, or are you comfortable?
I'm comfortable.
Okay.
But also confused, like maybe everybody else that we talk to.
Yeah, absolutely. I suppose then what we'll do is we'll turn to a couple of the audience questions, and thanks for everyone who has sent some through. The first one, maybe Vic, I don't know if you want to take this one. So what is your view on inflation-linked bonds, both the short end and the long end of inflation-linked curve?
So we manage an inflation-linked bond portfolio, I mean, which, by the way, has done quite well in comparison to the peers. Managed by Robin Melder, I mean, one of the portfolio managers, I mean, within the team. And this is the asset class where we have done quite well, by the way, even in terms of positioning on our portfolios, including our bond portfolios, which are benchmarked to the all bond index. So we've included inflation-linked bonds as an off benchmark positioning. And the reason that we did that, is because of the way that inflation has been behaving, has been rising. There's been a lot of inflation carry, the benefit that you get as inflation moves higher and you are in inflation-linked bonds in the short to medium term. So as a result, I mean, as you would have seen if you were to look at the returns, the jaws of returns between inflation-linked bonds and nominal bonds have actually been opening, quite wide. So in an environment like this, where you're not so sure where inflation is going, it actually, I mean, it makes sense to have some inflation-linked bonds, I mean, on the fund. As to the positioning of shorter dated inflation-linked bonds and longer dated inflation-linked bonds, there are several factors, I mean, there are other factors, that you have to factor in. The short end, from a break-even point of view, would look, attractive, just because we know where that inflation curve that we're talking about is going. So basically, you can add value by buying shorter dated inflation-linked bonds while having lower sensitivity to the market. Like if you get it wrong and the yields actually on inflation-linked bonds and the yields actually start to move higher, you can still make money on shorter dated bonds without sacrificing any capital because you got the market wrong. The long end of the curve probably may be relatively expensive. In comparison to say nominal bonds, where they are sitting. But that space, of break evens, is going to have to play out. Down the line when this frothiness, that I've talked about comes into play. So in the long term, if central banks are able to control inflation, obviously you also want to pick a perfect point where you reduce your exposure to ILBs because your better returns are going to come from nominals. So in our TAA meeting, which we had today, Slide told you about 18%, for example, but you could actually still pick it up at better levels. The total returns on ILBs on a relative basis, it's slightly lower than what you would get, on nominal bonds. But in the short term, yeah, it does make sense while you're having some volatility to have inflation-linked bonds on your portfolio.
Okay, brilliant. And then maybe one here for you, Slide. Just how are the SARB doing on terms of issuance of bonds at auctions? Are you seeing bid to covers on the midterm bonds are weaker?
Yeah, so for over the last 3 weeks now, or I guess it's in this leg higher, as I said, beginning of August, we saw bond yields crashing down. They've ratcheted up about 60 basis points. As you can imagine, given that generally our peers are very long bonds. So there hasn't been much support for the weekly auctions. They're still able to issue from the nominals, their normal, 4 billion, 3.9 billion rands a week, but the bid to covers are very low, which says it's mostly banks that are buying in the auctions now. And you can see it even with the price action post the auctions, because banks, they're primary dealers, they are contractually obliged to buy these bonds. They turn around and sell them in the market, which leads to even more weakness in the market. For inflation-linked bonds that Vic was speaking to earlier, especially the last auction, so there the government doesn't have to issue the full size. So if the bids are way high, the government basically can issue, or they can do as little as there, and which is what they've been doing now, given the froth or the volatility and negativity in the market now. I guess from from an issuance perspective, which is very positive for bonds, is the introduction of the floating rate notes. The first 2 auctions that we've seen, the total bids at each of the auctions was over 29 billion rands, meaning there's a lot of money that's looking for exposure in floating rate notes, especially now that interest rates are moving up. But also given that those are issued at 3-month JIBAR plus 110, 120 basis points, that lowers the interest cost for the government materially. And we wish they could do more and actually build a floating rate note curve like they did in the fixed space, which and that will be fiscally positive and will probably lead to the risk premium that's in the bond curve, in the fixed bond curve, to unwind a bit.
Okay, and then maybe I'll stick with you for this one, Slide. Just in terms of, I think Vic alluded to it earlier in when he was setting the scene, but what actually makes the SA bond market more attractive than some of our emerging market peers? Some of them have equally attractive, sometimes better yields on offer. What makes us more attractive?
Well, first thing, I think you should have turned down the heat in this studio of yours, Dave. It's hard enough we have to contend with the heat in the market, but anyway, we're sitting here. So I think when you speak to foreign investors, right, the way they look at South Africa, we here, right, we in the heat, we see all the negativity, all the potholes, Eskom, this, that, right, and we tend to be very emotive at how we approach bond markets. But as an emerging market foreign investor, the first question is, if I put money into this country, will I be able to get it back? Will the sub wake up one day and say, exchange controls, you can't get money out of the country? No, right? If that's the case, is the court system robust enough? Are the checks and balances, is there recourse for me to go and challenge this in the courts to get my money out? And we know our constitution is intact, and there is good cover there. But also importantly, if I put in 100 rands into South Africa, can inflation go as high as Vic was saying to 80%, and that 100 rands is now worth 20 rands in real terms? No, because of the central bank credibility. So there's just so many checks and balances that from an external investor point of view, you sort of get the assurance that before even worrying about the return on capital, return off capital is sort of guaranteed, right? Unless market moves against you. But more importantly, we have a very deep and liquid market, both on the currency and the bond side, right? It's positive, negative, because some of our emerging market peers are not as liquid or as deep. Sometimes foreigners will sell our bonds and our currency as a proxy when there's risk off, but it works well when there's risk on. So those are the major things that we count in our favor. And also more importantly now, especially recently, the fiscal risks have reached the bottom. We've turned the corner. And that's why we even see positive news even from the rating agencies coming through. And that it makes South Africa maybe one of our clients, female clients, said this is wrong, but I have no other way to phrase it, to say we are the least ugly of the ugly sisters, which then, bodes well for us. Sorry if it came out sexist, but
no, 100%. Yeah. Well, thanks for that. I think in the interest of time, I'm gonna close there. I think any of the other questions that have come through, we will get your investment specialist to get back to you with answers to those. But thank you for sending them through. Thank you for the time this afternoon, and thanks Vic and Sla for your time as well and for the insights. I hope that we've illustrated to you guys that the STANLIB Flexible Income Fund is a fund that does have a flexible mandate, and it's a flexible mandate that is utilized, which is incredibly important. It's one thing to have it, one thing to use it. So we thank you for your time. We hope that you guys have a great afternoon, and we'll be in touch soon.